China just pulled the plug on the global gold market, and that single decision is about to trigger a vertical supply side run towards a $1 million Bitcoin valuation. While the mainstream financial media is completely blind to the connection, tracking short-term price movements and daily asset corrections instead, a massive structural trapdoor has officially opened beneath the traditional finance market, unlocking the exact allocation model that pushes Bitcoin to seven figures. On June 24th, the Industrial and Commercial Bank of China, the ICBC, the single largest banking institution on Earth by assets, issued an emergency directive. They announced they are completely shutting down all retail paper gold trading across their entire network, effective July 24th, 2026. This is not an isolated corporate incident. It follows a rapid-fire cascade of shutdowns from the Postal Savings Bank of China, Pinggang Bank, and China Guofang Bank. One after another, the dominant pillars of Eastern wealth are locking everyday citizens out of the gold casino. The official story claims that they are protecting retail investors from volatility, but here's the truth. China isn't stopping its citizens from owning physical metal. They are intentionally destroying the paper claims against that metal. Because for decades, the true price of gold has been artificially suppressed, diluted, and manipulated by multi-trillion-dollar paper casinos. By shutting down the paper market, China is forcing real price discovery to happen. But more importantly, they are leaving trillions of dollars of domestic retail capital completely stranded. And that stranded capital has only one mathematical exit ramp left to travel. We will expose exactly why China's gold shutdown is going to be the ultimate catalyst behind Bitcoin's vertical expansion towards that $1 million mark, how Wall Street is trying to use the exact same paper traps to convince you to sell your Bitcoin, and how you can position your personal portfolio to capitalize on this historic capital rotation before the July 24th deadline. To see why China's retail trading ban is a global systemic trigger that directly paves the road to seven-figure Bitcoin, we have to look at the massive disconnect between what central banks are doing and what retail investors are allowed to see. At the start of this year, some of the largest macro hedge funds and private allocations made a highly publicized bet. They projected that gold could surge as high as $20,000 per ounce due to massive geopolitical instability and debt expansion. But look at the reality today. Gold is trading closer to $4,000. It hit an all-time high of over $5,000 back in January, but then it suffered a violent, sudden 30% liquidation crash. To contain the damage, Chinese commercial banks aggressively jacked up the margin requirements for retail investors to an unprecedented 140%, a record high for the entire banking industry. A margin requirement is simply the amount of collateral a trader needs to post to borrow money. By lifting that requirement to past 100%, China's banking system is demanding more physical cash from you than the entire investment contract is even worth. They are making it mathematically impossible for an ordinary citizen to borrow money to trade gold. The official narrative says that this is a benevolent move by a big government to protect regular people from losing their shirts. But the unofficial story, the one that actually matters for your portfolio, is that the battle for real money and global purchasing power just turned hot. China is systematically wiping out margin trading, leverage deferred contracts, and short-term speculation. They're completely fine with people buying physical bars and storing them in a vault system, but they are pulling the plug on the paper claims. Why? Because Eastern institutions realize that the true price of scarcity is being heavily suppressed by Western paper markets. To allow physical assets to reach their true macro value, you must first shut down the ability for the public to gamble on the paper version. To see exactly how a paper market successfully suppresses the price of a scarce asset and keeps Bitcoin artificially discounted from its true $1 million potential, let's look at the financial math through a simple visual analogy. Imagine I own a highly rare, highly pristine collectible card, like a retro Kobe Bryant card. It is locked inside my safe, it's real, it's tangible, and there is mathematically only one in existence. Now imagine I print up a clean paper certificate that says, this document entitles the bearer to exactly one Kobe Bryant card stored in my vault. I sell that certificate to you. You are completely satisfied because you now own it legally, binding the claim on my scarce asset. But you choose to leave the card in my vault because you don't want the risk or logistical hassle of a personal custody. Once I realize that you and investors like you never actually show up at my vault door to demand a physical delivery, a massive institutional incentive is born. What stops me from printing a second certificate, a third one, and giving it to another buyer? On paper, the market data will look at my certificates and conclude that the supply of retro Kobe Bryant cards has expanded 100-fold. But in absolute reality, nothing has changed. There is still only one physical card sitting in the safe, but because the market is pricing the asset based on the massive float of paper certificates, the true price of that card is suppressed to a fraction of its actual worth. This is the exact operational framework of the Western paper gold market in London and New York. Trillions of dollars in gold contracts are traded every single day, yet the vast majority of people never intend to take a delivery of a single physical bar. It is a closed-loop casino of paper claims. And by writing vastly more paper claims than there are physical pieces of metal sitting in their vaults, institutions can artificially expand the supply and control the global price index. China is actively detonating this illusion. This is exactly where the gold market hits a structural wall, and it is the exact mechanism that triggers Bitcoin's biggest run towards $1 million. If you are a retail saver looking at accelerating currency debasement, you want to escape into a scarce asset. But if the banks completely switch off your access to paper gold contracts on July 4th, your primary investment vehicle vanishes. You cannot easily buy 50 pounds of physical gold and walk out of a bank branch with it. Gold is too heavy, logistically impossible to transport safely, and completely restricted by government export laws. So when the paper gold door closes for hundreds of millions of retail investors, where does that multi-billion-dollar wave of capital go? It searches for an alternative asset that possesses absolute scarcity, but carries zero physical weight. It searches for an asset that cannot be diluted by a banking system, cannot be restricted by an international border, and can be easily audited in seconds. It goes straight into Bitcoin. Bitcoin is the ultimate evolutionary leap past gold. Mathematically capped supply of 21 million units that no central bank can alter. Of those 21 million, on-chain forensic data shows that at least 4 million are permanently gone, locked in dead addresses forever. This leaves a real available float of just 16 million Bitcoins. When the largest retail savings demographic on Earth is blocked from trading paper gold, their capital flight into the weightless Bitcoin ledger creates an unprecedented demand shock. When you route trillions of standard dollars into a fixed, tiny float, the price doesn't wander gradually. The allocation model dictates that it must violently jump. That is how the math behind a $1 million coin becomes a reality. But as this massive Eastern capital flight prepares to trigger a historical vertical run, Wall Street's institutional elite is frantically trying to execute the exact same paper suppression playbook over here in the West. Institutional banking cartels have spent over a decade calling Bitcoin a fraud. While they were publicly attacking it to keep you confused, their internal mathematic teams were studying the paper gold trade and the paper gold market. They realized that they could never alter Bitcoin's underlying code, can never print fresh coins out of thin air, so they decided to build a massive paper infrastructure right on top of it using spot ETFs. The mainstream financial headlines are predictably flashing pure red panic, screaming that the spot US Bitcoin ETFs just suffered their worst month in history, with the record-shattering 4.5 billion exiting the complex in June, led by BlackRock's IBIT bleeding 3.5 billion. The news wants you to look at those outflows and assume the asset is dead and panic sell your holdings. But practicing forensic analysis reveals that this is a coordinated, artificial liquidity shakeout. Wall Street is using their paper instruments as a massive liquidity sponge. When macro interest rates remain elevated due to a hawkish Federal Reserve, institutional fund managers temporarily rotate their paper ETF certificates back into government bonds to chase risk-free yields. This corporate rebalancing triggers a sudden price drop on public stock exchanges. The average retail investor looks at the dropping chart lines, panics, and sells their physical holdings straight into the market. They are voluntarily giving up their pristine physical collateral to a giant institutional algorithm that has a 10-year time horizon minimum. Wall Street wants you trapped inside their paper ETF casino, holding digital certificates that they can control while they lock away the real asset. Comment not your keys if you made it this far in the video. But this is where Wall Street's master script completely breaks down, and it is the exact reason why China's gold shutdown will trigger an unstoppable Bitcoin run. Physical gold failed to defeat the paper certificate fraud because regular citizens could never audit a central bank's vault. If an institution claims that they have metal backing your paper certificate, you have to trust them. You cannot verify the physical bars yourself. Bitcoin is a pristine digital property governed by an uncompromised, transparent network ledger. You do not have to play Wall Street's paper game, and you do not have to accept their digital certificates. You possess the technological power to initiate a personal bank run on the institutional elite at any moment. The exact second you move your capital off a centralized exchange or corporate ETF product and route those coins into a private self-custody cold storage vault, you permanently smash their fractional reserve engine. Because unlike the paper gold market where institutions can print endless claims against an unaudited vault, they cannot fake the crypto signature on the blockchain. When global retail allocators choose self-custody for their wealth, the paper supply collapses, forcing the market into a brutal vertical supply-side liquidity crunch that will reprice the asset towards its true seven-figure value forever. We are marching rapidly towards the year 2030. By that definite date, more than 98% of all Bitcoin that will ever exist will have been completely mined out of the network. The block subsidy will be microscopic, and the native inflation rate of the system will sit at effectively zero. Do not focus on the short-term noise of the financial media. Focus entirely on your defense. The math is real, the supply is fixed, the float is shrinking. The only live variable is where the demand goes next. And when the paper illusion shatters, we know exactly where that heads. Like, subscribe, check out the community in the description, and I'm gone.